Right now, the global economies have got a ton of stimulus in them. Even China's running a deficit. So the only reason we're all feeling this good is because governments around the globe are printing money. And they're using all that printed money to prop up the economies. And you referred to the housing market where, as I'm sure you know, the homebuyer tax credit goes away fully at the end of June. A lot of these things, and you had to have obviously the contract signed by April 30th. As that stuff goes on, things are going to look a lot tougher as all that stimulus gets removed, and you've got countries in Europe, et cetera, cutting back. So my general, take on things right now is I'm in the camp of we have a double dip recession. I've been saying this for a while, and unfortunately, what I've seen so far this year, tends to indicate to me that maybe things are moving a little bit faster than I had originally anticipated. My thought had been we'd be fine through the first part of this year and be late this year or early next year before we had some real issues. And obviously, we've seen a lot of those things get pulled forward a little bit. So I don't see any reason not to be completely cautious. And then here, I'll give you an analogy. If you go back to look at the 1920s, as some of your listeners may be aware, there were the Roaring 20s, if I remember correctly. And so you got into 1929, and when the crash occurred, the stock market went down 48%. And then what people forget was there was a 48% rally off the bottom after the crash in 1929. And the market ended up being down about, I think, 22, 23% from its all-time high. And then the market went down over the next 2 years another 80+%. Right. So if you look at what we just went through, the S&P came from an all-time high in October, went down 57%, rallied 80%, which put it down about 22% from its peak, roughly the same level after the rally off the crash in 29. And now the stimulus is being cut back just like it was in 1930. And the economy seems like they're starting to slow. And, we're going to see how bad this gets. So I think I hope I'm wrong, but I look at the amount of debt that we've incurred across the globe. I saw how ugly it was when all these telecom companies couldn't borrow money anymore that they didn't have. We've seen how ugly it was when the consumers couldn't borrow any more money that they didn't have. And, now we're going to see how ugly it's going to be when the biggest of all, which is the governments around the globe, can't borrow money that they don't have. And that's what scares me, because each one of these downturns has been nastier than the one before, because the companies in trouble have been bigger or the entities in trouble have been bigger than the ones before.
I am with you 100%, Dan, and I think an awful lot of investors are coming around to this conclusion. Very, very briefly, the timing can be extremely difficult. Is there a chance, or is it even a possibility, that these governments can continue to kick the can down the road and we can kind of, do what we've continued to be doing? I mean, isn't there at least a possibility that could continue for, I don't know, maybe another 5, 10 years, or could you just offer really?
No, I don't. I really don't think so, because to some degree you've already started to see it spread. I was actually more in your camp, in the sense that people inherently want to believe it's going to be good. I want to believe it's going to be good. I own a home. I don't. I plan on living here because my family and I, we like where we are. But I know every day the value of my home is going down. And if I'm right, it's going to go down a lot more. So I really don't want to believe that. But, that's probably the harsh reality of it. And I think the problem is, for most people, if things get bad, there's not a lot to do to protect themselves in that environment. So to your point, my thought was that we'd have people kicking the can down the road, pretty far. But what you've seen this year is that you saw the amount of money it was going to cost Greece to borrow in the markets for a 2-year span of time go up to 15%,
right,
in several weeks, as as governments and other investors said, whoa, we're not sure that you can pay us back. The problem is you're seeing borrowing costs in a lot of other countries, like Spain, for example, which is the one I worry about a lot right now, starting to ratchet up as well. And so, the markets are enforcing discipline in a very simple way, which is as these countries come out and try to borrow money, investors are not as certain that they want to lend it to them. So that's why I look at the way things are going and say, okay, we've migrated from having, a problem with a Greece, which is not small, but, number 28 on the list of global GDP, moved all the way up to Spain, which is number 9. And if you look at countries like, the UK, which is sitting at number 6, or, obviously the US at number 1, it's not like our debt situations are that great either. So that's why I'm not certain that this is going, we're going to be able to put off the inevitable for a couple of years. Now,
right.
the thing you have to remember is that, and here's sort of the analogy to what you're talking about, you can end up with some wonderful rallies in between. So, this is the example I'll give you. If you look at when the tech bubble burst, if I went to you and I said, hey, you know what, I have a great investment for you, I guarantee you that this index is going to rally 6 times, and each of those rallies is going to be 15% apiece on average, and each of these, and this is going to occur over a 2.5-year period of time.
Right.
So, and I could tell you that with complete confidence. You'd be like, wow, this just sounds like a great investment idea. Well, that unfortunately would be when the tech bubble broke, and you would have lost 49% of your money. Because even though you had 6 rallies that were 15% apiece, the downturns you had between those rallies, you lost everything that you made and then some. And that's the problem right now, which is a 15% move on the S&P is pretty good. And every time the S&P had one of those moves, somebody called the bottom, somebody said this was the end of the bad news, and then you lost even more money. And then somebody called the bottom again. And that happened 6 times in a row. So that's why I look at this, and I think, unfortunately, investing is part art, part science. You have to look at things and say, well, if it gets oversold enough and governments decide, let's say, for example, Europe hasn't done quantitative easing yet, right? When by that what I mean is that as they're going ahead and buying sovereign debt, so let's say, Germany goes ahead and buys Greek bonds because they're trying to prop up Greece, what they're saying is, well, we're going to go out and, sell some other assets that we have, so to try to balance that, or that's what the European Central Bank is doing. Excuse me, not Greece. Now, if they decide to, they can decide to do what the U.S. has done, which is say, you know what, we're not going to go ahead and sterilize this at all. We're going to do what's called quantitative easing, where we're just going to create the money out of thin air, like we've done in the U.S., and we're just going to go ahead and buy all those bonds. And and that'll help prop things up for a while. So, but eventually you can't print money forever because, as most people know, you have all sorts of other bad things happen, which is massive currency devaluation, runaway inflation, and so you can't get away with that forever. But you can create short periods of time where you have these wonderful rallies, like you had in 1929 to 1930, at 48%, like we just saw recently here, and like you saw during the tech bubble breaking. And and that's what makes it hard, because everyone wants to believe that it's going to get better. I want to believe it's going to get better, but
Right.
I look at the facts, and just like with the housing bubble, I'm just not sure that there's any easy way out of this.
Well, Dan, I want to thank you very much for the terrific insight and your candor, because the one thing that we don't want to be at Benzinga is a bunch of shills for the analysts, the Wall Street community, the people selling securities. Our readership is investors, and I think that your candor, and we had Peter Schiff on the other day. This is really what helps people out. Are there some bullish arguments to be made? Sure there are, but there's also an awful lot of risks, and investors need to be aware of it. So I want to thank you again for coming on and talking to us.